Okay, let's jump right into this. Welcome to This Explainer, where we are digging into a massive, multi-billion-dollar mystery sitting right in the middle of the biotech world. We're looking at Revolution Medicines, or RVMD. Now, here is a company with literally billions of dollars in the bank, incredible clinical progress on cancer-fighting drugs, and a pipeline moving rapidly toward pivotal trials. On paper, it sounds like a guaranteed home run, right? Well, not quite. The real story here is that despite all of this apparent amazing success, the stock still has to prove that the future investors are paying for today is actually worth the price tag. It's a fascinating look into how the market prices hope versus reality, so let's dive right in. So let's start with a massive, eye-popping number, $3.94 billion. As of June 30, 2026, Revolution Medicines boasts a fortress-like balance of cash, cash equivalents, and marketable securities. At first glance, almost $4 billion looks like absolute total safety. It looks like a company that has essentially de-risked its financial future and has all the runway it could possibly need to make its science a reality. But hang on a second. Before we pop the champagne, we have to look at the flip side of the ledger. They carry an accumulated deficit of approximately $4 billion. They've already spent an incredible, massive amount of money just to get to where they are today. Now, to be fair, biotech companies don't burn cash because they're broken. They burn it to turn complex science into real medicine. But the critical thing to watch is that they are rapidly accelerating this spending. And this spending isn't just creeping up. It is accelerating at an absolute dizzying pace. Just look at their second quarter financials. Research and development spending jumped roughly 76% to almost $395 million. General and administrative costs, those skyrocketed by a whopping 172%. In fact, management is now projecting that their 2026 operating expenses alone will be somewhere between $2.1 and $2.2 billion. Let that sink in for a minute. All this massive cash burn really forces us to take a step back and ask a crucial question. Is that $3.9 billion actually a cozy cash cushion to keep investors safe? Or is it literally just the bare minimum fuel required to keep their clinical engines running over the next few years? Now, as if that cash burn wasn't enough to make you sweat, throw in some recent headlines about insider sales. If you're scrolling through financial news, seeing the C-suite sell off their own stock looks, frankly, terrifying. You immediately think, wait, if management really believes in this multi-billion-dollar future, why on earth are they cashing out now? But as focused learners, we know we can't just react to splashy headlines. We have to look closer. If you actually crack open the SEC filings, it's explicitly stated that these insider transactions were executed under Rule 10b5-1 trading plans. Now, what does that mean? It means this is a predetermined, automated arrangement an insider sets up well in advance to sell stock on a specific future schedule. So the crucial point here is that a sale under this rule doesn't automatically mean management is suddenly bearish or jumping ship. It's very often just routine personal financial planning. So instead of panicking over a headline, expert investors use a specific framework to dissect these sales. They ask stuff like, okay, was it a 10b5-1 plan? When was that plan established? How big was the sale compared to the shares they still hold on to? Is the selling widespread across the whole C-suite, or is it just one person? Is it tied to tax obligations? And most importantly, did the company's fundamental science change after the sale? Since insider selling doesn't seem to be an immediate red flag here, we have to find out what these insiders are actually betting their careers on. Because the insiders aren't fleeing a sinking ship, we absolutely must investigate the specific drugs they are developing. We have to figure out what Revolution Medicines is truly, tangibly worth if it succeeds in the clinic. Enter their superstar candidate, RAS. Now, you probably know the biotech industry has struggled for years to target these tricky cancer drivers called RAS mutations. Well, RVMD essentially built their whole operation around cracking this exact code, and they did something huge. In their pivotal phase 3 trial, the RAS-LUT 302 trial, they reported statistically significant improvements in survival rates compared to standard chemotherapy. The FDA has officially accepted their new drug application for review, and the company is saying they have achieved U.S. commercial launch readiness. Folks, this is no longer just an abstract hope, it's right on the doorstep of reality. But here's the kicker, and this is what makes the story so fascinating. RVMD is not a one-trick pony. They aren't betting the entire farm on one single drug. They are building a massive platform. Beyond daraxonrasib, they've got zoldonrasib, elironrasib, and RMC 5127, and each of these is designed to target different, specific RAS mutations. Think about it.
If the underlying technology works across the board, the economics of this entire company completely change.
Now, their initial splash, those spectacular phase 3 results, were mostly in previously treated metastatic pancreatic cancer. But because this is a broad platform, they're eyeing some massively bigger markets. This really prompts us to ask just how far this scientific platform can go. If it works so well in the pancreas, could they tackle other major, incredibly hard-to-treat cancers? And the short answer is absolutely yes. They recently reported some combination therapy data in lung cancer that showed a frankly wild 82% objective response rate, meaning the tumors actually shrink in 82% of cases, and a 100% disease control rate, where the cancer just stopped growing altogether. That sounds earth-shattering. But here's where we have to apply our critical thinking and look at the fine print. This was only across 28 patients with a short median follow-up of just 3.4 months. So the crucial takeaway is that while this is highly promising, this result still has to survive a massive, rigorous, randomized phase 3 trial before it becomes a commercial reality. And this brings us right back to a harsh reality in the biotech world. Let's just assume for a second that the drugs work flawlessly. Does clinical success automatically equal a money printer? Unfortunately, no, it doesn't. We have to factor in real-world hurdles. How many patients are actually eligible for the drug? What percentage of revenue goes to partners, existing royalty obligations, and of course, the incredibly massive costs of building a commercialization infrastructure totally from scratch. Plus, we have to remember, they aren't operating in a vacuum here. Revolution Medicines is running a ruthless race against industry heavyweights like Amgen, Bristol Myers Squibb, and AstraZeneca. These competitors also have RAS targets in their crosshairs. Some even already have approved products on the market, whereas RVMD does not yet. So RVMD doesn't just have to prove their drug works, they literally have to prove their approach is commercially superior to these massive pharmaceutical titans in order to justify their sky-high valuation. Surviving that competitive gauntlet and actually commercializing these drugs is going to require an astronomical amount of capital. Which brings us full circle back to the financials. With $2.2 billion in projected operating expenses for 2026 alone, we have to ask the uncomfortable question: who is ultimately footing the bill for this? And the answer, unfortunately, is often the existing shareholders. Let's talk about what I like to call the dilution trap. In April of 2026, RVMD raised an incredible $2.225 billion. Awesome for keeping the lights on for sure, but $1.725 billion of that was common stock, meaning existing shareholders just got heavily diluted. They now own a significantly smaller piece of the pie. On top of that, they effectively mortgaged a chunk of their future drug sales to Royalty Pharma in exchange for an immediate $250 million. So even if this drug is a mega blockbuster, the headline revenue numbers of the future won't all flow directly into today's shareholders' pockets.
So what we have here is an epic clash right at the heart of RVMD. In one corner, you've got this super powerful bull case. An FDA approval is knocking at the door, they are primed and ready for commercial launch, they have a broad platform and solid international partnerships. But fighting aggressively against that is a severe bear case. The ever-present risk of late-stage clinical failure, fierce commercial competition from literal titans, massive cash burn, and painful share dilution. It's a high-stakes tug-of-war.
But here's the golden rule of investing. A fantastic company with mind-blowing science can still be a terrible investment if you buy it at the wrong price. So expert investors move past simply asking, hey, is this company good? Instead, they ask, what level of perfection is already priced into the stock right now? To figure out what's priced in, you have to map out the entire investment equation. You're effectively assigning probabilities to this long, precarious chain of events. First, you have the science and clinical evidence. Then, crossing the massive hurdle of FDA approval. Then, actually executing a successful, profitable commercial launch. Then, subtracting the cash burn and the royalties you owe your partners. Only after all of those dominoes fall perfectly without a single hiccup do you finally get to step 5, actual shareholder return. It's all about trying to predict those future, probability-weighted cash flows. So let's bring it all together for our final scorecard. The scientific opportunity and the sheer cash position. Undeniably strong. But their current profitability is weak, their cash burn is incredibly high, and the commercial risk against big pharma is severe. Therefore, Revolution Medicines is a highly speculative play. It could be a buy, but only if you accept extreme biotech risk and ensure the valuation actually provides a margin of safety. Conversely, it's a total avoid if you cannot tolerate the massive cash burn, the looming dilution risk, and the very real chance of a clinical setback. Which perfectly tees up this quote right here. The market isn't paying for what Revolution Medicines is today. It's paying for what Revolution Medicines might become. And today, there are no earnings. Ultimately, that $3.9 billion cash pile, the insider selling headlines, and even the amazing Phase 3 clinical results aren't the real answers. At the end of the day, it all comes down to whether the cash flows of tomorrow justify the sky-high expectations of today. And that leaves us with our final, absolute, most crucial question, one that you really have to ask yourself if you're playing in this space. Has the market already fully priced in a best-case, picture-perfect scenario where Revolution Medicines becomes a massive, flawless success? Because if perfection is already priced in, where exactly does the upside come from? That is exactly what you should investigate next. Thanks for hanging out with me on this explainer. Keep asking the hard questions, and I'll catch you next time.